All right. Good afternoon from London. We'll get started here in just a moment. We've got participants joining us from all around the world today. We thank you for your time. Looking forward to sharing with you the market outlook from the past 30 days. So the best of times, the worst of times. Stay tuned. Okay, we're going to go ahead and get started. My name is Nicholas Carey. I'm the co-founder of blockchain.com, the founding commissioner of the Blockchain Commission for Sustainable Development, and the author of The Future is Decentralized. I want to thank everyone who's joining us today. We have quite an extensive audience, both community members from the cryptocurrency space, from traditional markets, as well as some journalists that are joining us for insights and commentary on what's going on in the cryptocurrency and broader markets. So a quick update here from blockchain.com. Who are we? Blockchain.com is the world's leading cryptocurrency platform. We're on a mission to make it easier for all people to send, receive, secure, and trade digital forms of money. And so we welcome you to sign up for a cryptocurrency wallet if you haven't tried that before. I want to give you an update on some things we've been working on here. If you haven't noticed yet, we've launched a new logo for blockchain.com, so we're really excited about that. We've shipped a ton of updates to our wallet and our exchange, so you'll see a new homepage, UI and UX improvements, as well as updates to the iOS and Android apps. We have just launched an interest-bearing account. We'll be talking a bit more about this today in the context of either zero or negative interest rates and how consumers and retail customers can actually earn interest and develop wealth. And that'll be something we cover in our presentation. We've also launched the fastest buying experience in crypto. So for new cryptocurrency users, they often want to get into things now and get there quickly. And so we've been spending a lot of time working on this over the past year and have been rolling that out, which is really, really cool. And we also are proud to excited to announce that XRP is now live on the blockchain.com exchange. We'd love to have everybody check that out. And it may happen during this presentation, but we're about to pass the 50 millionth wallet sign up on blockchain.com, which is just an incredible milestone for the community and for the team here. So we're quite thrilled about that. So today's focus, we'll get to there in just a moment, but I want to share kind of a recap of what we spoke about a month ago. We looked at why Bitcoin was outperforming gold, but not bonds. We've seen pretty strong performance from Ethereum and questions around whether or not that will continue to outperform against Bitcoin. We spent some time talking about the macro market and wondering whether or not there's kind of been an unhinging from real balance sheet issues, or whether or not that was going to maybe complicate things for the crypto markets. There's been sort of deceivingly low transaction volumes and some issues around the hash rates and some questions around those things. And then of course the Bitcoin halving and halvening event. And we did finally settle the issue once and for all about whether or not we should use one word or another, and we'll be sharing that in just a moment. So without further ado, today's focus, it has been a historic few months, and the historians will be writing some pretty interesting chapters in the history books on the tail end of all this. So to help us make sense of everything, please let me introduce Dr. Garrick Heilman, a friend of mine and a colleague. He heads the research team here at blockchain.com, and he's one of the world's most cited cryptocurrency and blockchain technology researchers. He created and taught the first course on blockchain technology at the University of Cambridge and has authored leading research on cryptocurrencies, markets, stablecoins, and broader trends. He is ranked as one of the 100 most influential economists in the UK and Ireland, and is regularly asked to share his research and perspectives with government organizations, including things like the FT, the BBC, the CNBC, Wall Street Journal, NPR, and many other media sources. So we're very lucky to have him today. And so I'll pass it over to Garrick now. So thank you very much, Garrick.
Great. Thanks so much, Nick. Great to be back with everyone here in June. And we're going to start off the agenda today with looking at what happened in May and into early June, what's driving the markets. And we're going to be kind of building on our discussion we had last month, where we're kind of looking at the broader market activity and trying to connect the dots with how that shapes what's happening in crypto. In the second section, we're going to talk about what happened post-halving from a security perspective. We blogged about that, and we'll be covering some of that material. in section 2. And then I'm going to hand over to my colleague, Tony, who's one of our data scientists, to talk about on-chain insights in section 3. And then we'll kind of finish up with kind of, again, looking big picture at what's happening socially, politically, with the virus, with China, and again, what this all means for crypto, what things like Fed Chairman Powell's statement and the FOMC statement yesterday that it's going to be zero interest rates through the end of 2022, 2.5 years in essence of projected zero interest rates, what that means for crypto, what that means for our users and how they can take action. So that's the agenda. Let's get right into it. What drove markets in May? What was the story with May? Well, we saw a continuation of cryptos performing quite well in May. Both Bitcoin and Ethereum were up double digits, 10% and 11% respectively, outperforming gold and stocks, which both also were up. And we saw long dated bonds, the TLT ETF sell off a bit, down 2%, US dollar selling off a little bit. So, traditionally this is kind of a, risk off kind of picture, or sorry, risk on kind of picture where people are moving out of dollars and bonds into things like stocks. In this environment, crypto did quite well, as did other traditional hard assets like gold. You can see that year to date, Bitcoin is up 34%, Ethereum up 81%. So continues to be a really strong performer. A lot of anticipation around the Ethereum 2.0 launch, the prospect of being able to stake and earn rewards for staking ETH, I think is certainly a big part of the story that's driving what's happening with Ethereum, as well as very strong demand for decentralized finance in the form of borrowing and lending and various other DeFi products and services that are available. And so we're as a company, of course, excited to kind of help our customers start to participate more and more in borrowing and lending at the retail level. We've been doing this for institutions for quite some time now. So when we look at the fundamentals on the Bitcoin network, it was a very strong month across the board for Bitcoin. Market cap up 9%, total number of transactions up 5%. Our own platform saw growth in transactions plus 9%, and an increase in the market share, if you will, of blockchain.com user transactions as a percentage of the total Bitcoin network, climbing from 31% to 32.5% from April to May. These are all things we're very proud of, the fact that we continue to have a very large footprint in the Bitcoin network. Total number of active addresses increased 12%. That was the highest percentage increase of these metrics we're showing you here. And this is important as we think about a larger and larger number of users transacting on crypto assets, on blockchain networks. We want to continue to see, I guess, a broadening of users in the space. And this is one of the metrics we can certainly use to kind of try to gain some level of insight into whether or not more and more people are actually using various networks. Now, we want to talk about what's happening again in the stock market. Although as we go to video today, markets are starting to show some sanity, maybe, if you will. For folks like myself who are old enough to remember the dot-com era, late 1990s, I had a front row seat in San Francisco watching some of the insanity of that period. A lot of the action in the stock market recently, frankly, has reminded folks like myself of kind of what we saw back in the late 1990s and early 2000. You're seeing some really quite interesting developments around, for example, some of these stocks that have declared bankruptcy. Very much could see equity holders completely wiped out. Hertz, others watching their stocks climb hundreds of percent. There's been a huge, and this is something that's been talked about in the media, a huge increase in the number of retail accounts opened at various brokerage firms. And, gambling has been closed for a period of time. Sports has been shut down. people may be moving into the stock market and driving a lot of frothy activity. We'll see. I mean, it's a very difficult kind of economic environment to kind of judge and say, oh, this is what for sure is going to happen. We'll be talking more about that later in the presentation. But again, I think the main message for the crypto space in terms of how to interpret all this is, as crypto has become more integrated into kind of the broader financial conversation, as Bitcoin and Ethereum as well start to be thought alongside more traditional financial assets, we need to kind of keep an eye on what's happening in these other markets as they are competing for mind share, and there's more kind of overlap probably than there's ever been. So it's an interesting time. We're seeing some interesting kind of things happen with various altcoins as well. Doing some interesting things. We'll see what this means for Bitcoin, for Ethereum, for some of the kind of larger cap, if you will, crypto assets. But certainly what's happening in the stock market is something we need to keep an eye on and think about in terms of crypto performance. So let's now talk about the halving and what it means for Bitcoin security. So as Nick mentioned, we ran a poll just before the halving last month, asking people which term they prefer, because there's two terms that have been traditionally used to discuss the every 4-year process by which Bitcoin's mining reward is cut in half: halving and halvening. And you can see that our user base strongly preferred halving, 75% to 25%. And so we want to encourage the industry to adopt this term because it's I think going to be a lot more helpful to explain and easier to explain cryptocurrency and Bitcoin to folks if we just have one word, one term to describe this every 4-year event rather than two, one term to check Google Trends to see how it's increasing in search and so on. But that was the result of our poll, and we'll be using halving when we discuss this event going forward. So thinking about security and what the halving means for Bitcoin security is I think a really important subject. The reason we are here, the bedrock, the foundation for why we are even talking about crypto assets and blockchain technology is security. If these networks were not secure, we would not be here. And this is of paramount importance. And one of the questions that always comes up with the halving is, when you reduce the mining reward, what does that mean for the security of the network? If the amount of compensation that miners receive for lending their computing power to the network, which provides security, is reduced, does that lead to a drop in security? And one of the simplest ways of looking at the security of the network is to look at the hash rate. This is a term that we coined a number of years ago to describe the amount of computing power that is securing the network and competing to solve the crypto puzzle that gives you the mining reward of new Bitcoins. And you can see that this, after the halving, there was a predictably pretty significant drop in the hash rate. Computing power dropped roughly 30%. But it's climbed back up to close to where it was just before the halving occurred. And that's certainly a healthy sign. There are other ways of thinking about security than just hash rate. And we get into this in a blog post we published mid last month called Battle Testing Bitcoin. And it's a part 1. There'll be a part 2 coming out as well, where we kind of look more into the future. But one of the metrics or ways you can think about security, and this is a very simple equation, so don't tune out if you don't like math. This is not that complicated. But you can look at kind of a market value adjusted security metric, where you take, in essence, the market value of Bitcoin and you divide it by the hash rate multiplied by the cost per hash to get what we call an MVANS ratio, the market value adjusted network security ratio. And what does this equation represent? What's the principle behind this? Well, it's very hard to know with precision, whether your network is perfectly secure or not. Really the best test of security is battle testing it, putting something out there live that can be attacked and seeing whether it can successfully survive, exposure to the broader world. And so one way that security researchers think about, this question of how secure a network is they look at the total value of the network, and they look at how long that value has been live or exposed to attack. And so the more valuable the network is, and the longer it has been successfully operating securely, the more secure it is often deemed to be. That's kind of the real world battle testing kind of formula that is expressed here in this equation. And basically the idea behind this ratio, this MVANS ratio, is the lower, the better. And if you look at the ratio over the last several years, we saw a huge spike at the end of 2017 when Bitcoin's price approached $20,000. But that ratio has been trending down steadily over time. And you can see that post-halving, if you go to the far right corner there, it really hasn't changed much from where it's been through this year pre-halving. So that's very good. In other words, the market value that is being secured relative to the hash rate is roughly about what it was. And actually, it should look even better than this with kind of the uptick in hash rate recently, just over the last several days. So that's all very encouraging. Another way, and this is where we're going to kind of give you a bit of a preview of part 2 of the blog post on security to think about Bitcoin security, is to think about the amount of mining revenue, which is equal to both the new coin reward plus the fee income. You can combine those to think of those as kind of a security budget. That's the real world dollar value that the network is generating to fund the security of the network. That's what miners have to work with to purchase computing power, electricity, and all the things they need to operate the mining and computing infrastructure that makes Bitcoin secure. And this table here is a projection of the security budget looking just at the mining reward, which we know will be cut in half roughly every 4 years. So from the current 6.25 new coins mined every 10 minutes roughly, to in 2024, the next halving, when the reward gets cut down to 3.125, to then 2028, when the reward gets cut to 1.5625, and so on out to the year 2032. If you assume that there is no change to Bitcoin's price during the next 12 years, the bottom row shows you how much daily reward will be generated at today's Bitcoin price. And what you see is it does decline, of course, from today's current 8.6 million down to about 1 million in the year 2032. And this is ignoring transaction fees, which Tony will talk a bit more about later. And so what does this mean? What does it mean that the reward portion of the budget, security budget, if you will, is going to be reduced from 8 million down to 1 million, again, at today's price? If Bitcoin's price goes up, then obviously this calculation changes. Well, we can take that $1 million figure and compare it to historical security budgets. And so, for example, the lowest amount of mining reward value and fee income that we saw from what I call the modern Bitcoin era, starting in 2017 to today, was $1.4 million. That was the lowest daily amount during the last 3.5 years that miners earned, mining Bitcoin, both through the reward and the fee income. And so what that says is I think, really powerful, that even if there is no fee income over the next 12 years, you're going to, and the price is held constant today, you're going to have, a security budget that is greater for the next 12 years than the lowest day we saw over the last 3.5 years. And this is not a perfect measure to kind of guesstimate, kind of how secure Bitcoin is. We only will know it's secure kind of after the fact, and it's been secure for 11.5 years. But it does provide, I think, some comfort around what level of security we can expect over the next dozen years, over a decade, just based on the mining reward and just based on maintaining today's price, which I think, we're obviously very optimistic about Bitcoin's price, and we'd be surprised if it doesn't go up from here. But anyway, that's a little bit of a preview for the part 2 security piece coming out this month. And with that, I'm going to hand it back over to Nick to introduce Tony here for the next section.
Thank you, Garrick. It was interesting. I saw that headline as well in Yahoo Finance from Fidelity just a few days ago, where they announced that 1/3 of big institutions are now holding cryptocurrency. And so what you're seeing is that while the education curve has often been long, the insights around the resiliency of these networks are proving themselves, which I think is a real nice signal. So switching gears a little bit, we've had some interest from both journalists as well as community members to share a bit more about some of the insights that we have and some of the proprietary information that our data science team sifts through on a day-to-day basis. So I'm very excited today to introduce you to Tony Dury. He is one of the preeminent data scientists here at blockchain.com and works with his team to bring you all of the charts and the analytics that are publicly available on the blockchain.com Explorer. He has a master's degree in computing from Imperial College and a background in mathematics. And he's chiseling out a role for himself here as our lead blockchain archaeologist, digging for insights and data on chain. And he's here today to share some of those recent discoveries. So without further ado, we'll pass it along to Tony.
Thank you, Nick. So as Garrick mentioned, we saw an increase in network activity. And this resulted in an increase in fees per transaction in May with over $3 per transaction in comparison to only 67 cents in April. So even if this appears maybe not appealing for people sending transactions, this actually has quite a positive impact on the mining because these network fees, let's remember that it goes directly to miners, and this will make the mining more appealing for them to come in. The more hash rate means and the network will be more secure. And we've seen that even if the fees increases in May, there are some times during the day that maybe it would be better to send transactions. So we will see in the next slide that the mempool occupation is not the same throughout the day. And if you were to send a transactions, it's better actually to send it in early morning. So we see here that the mempool size is like 20% lower in comparison to the rest of the day, early morning. And during this day, we see an increase most of the time. So this is based on May's data, but we see this pattern quite often because around 1 p.m. UTC time, there is BitMEX starting a lot of withdrawals, and this actually will start a huge congestion on the network, and this results in the mempool, so the mempool being where all the unconfirmed transactions are before being confirmed. And so this mempool being super busy in the afternoon will make transactions more expensive with higher fees. So remember to send them in the morning if possible. And then you can also look at what day of the week is best. And we see late weekdays, so Thursday, Friday, we see a spike in transactions, which takes about a day as well on Saturday to come back to normal occupation of a mempool. So once again, if you have to send it, it's early morning, and so especially on Monday and Tuesday, where you will pay less fees for your transaction, or if you want to select a higher priority fee, your transaction will be confirmed faster during these early days of the week. Then at blockchain, we have a chance to have users all over the world. We cover more than 100 countries, and we can look at whether countries are trending. So we looked at what countries were sending transactions in May in comparison to April. So this is the increase relative to other countries. And the top three is Ivory Coast, Dominican Republic, and Nigeria, which are not our top countries, but we've been increasing a lot in comparison to other countries in May or April. We can see South Korea and Brazil, Romania have been less present in our wallets because we saw less transactions sent from these countries. We can also mention the United States, which increased despite current events. And Italy were really hit hard by COVID and maybe had an impact on the decrease of usage of our web wallet. Another aspect to look at is how concentrated funds are on the blockchain. And there are around 30 million addresses in total. And we've seen an increase of active addresses in May in comparison to April. And it's better to look at how many addresses actually hold values. And there is about 10% of the total addresses, these 3 million of addresses that hold more than 0.1 Bitcoin. And this represents, so these 3 million addresses represent 99% of the total Bitcoins in circulation. And if you look at even a smaller subset of addresses, there are 310,000 addresses, this 3% of total addresses, which hold a minimum of 1 Bitcoin, and this represents 95% of total Bitcoins. So yeah, it's pretty impressive that only a subset of these addresses holds Bitcoin, and we would like to see this number increase to have the funds a bit more into different hands. So that's it for this time, I believe, and stay tuned.
Great. Thanks, Tony. Yeah, maybe I'll just add one quick comment on this last slide, which I think it's really important. It's a really important data point for tracking kind of growth of adoption and widening adoption. It's also something that this statistic of how tightly owned or how tightly controlled Bitcoin is something the SEC is also looking at when they consider things like a Bitcoin ETF. There's a concern that with any stock or any financial instrument, if there's too much ownership in too few hands, it can be it can be more easily manipulated and so on and so forth. So this is all very positive and healthy to see growth and widening of ownership of Bitcoin. It's certainly something that regulators are keeping an eye on as well as they consider things like a Bitcoin ETF. Okay, so zooming back out again to kind of the macro picture, we wanted to talk about crypto in the context of the Black Lives Matter protests, COVID, China, and what these latest developments mean for crypto assets. So China is, I think something that we're going to be spending more and more time on, in the crypto asset space. We already were. China's been a big driver of Bitcoin and crypto asset adoption since 2013. The first big push over $1,000, it appeared, was driven by China in late 2013, when things got a little shaky for China a few years back. We saw again Bitcoin's price respond, and then last spring when the renminbi started to weaken, I mean, there was almost a perfect correlation with the weakening of the renminbi in May of last year and Bitcoin's price moving up. That relationship breaks down sometimes. It's not something you can rely on, but it is certainly something that has driven a lot of, sorry, excuse me. Screen just switched. Okay, we're back. It is something that has driven a lot of, Bitcoin price action in the past. And today, is divided as a country like the United States is politically. The one thing that Republicans and Democrats agree upon, and we're also seeing some alignment in Europe and elsewhere as well, is the need to kind of, engage China, I think, a little more forcefully on things like trade and being a good kind of global actor in some ways than we have in the past. So, this isn't news, I think, for a lot of people. There's going to be additional tension, in this relationship with China. And, arguably, according to some observers, we're already in what we could be called not just a Cold War, but a hot war with regards to things like information, cyber, intellectual property, disinformation, and so on and so forth. There is growing concern about a kinetic war, in places like, Taiwan, for example. And this is all going to be, I think, incredibly important to keep a close eye on from the crypto asset space, because, look, wars are expensive. So traditionally, when wars happen, be they, information, Cold War style conflicts, or hot kinetic warfare, the costs to the state go up. That cost is reflected in increased public debts. And traditionally, when big wars like World War I, World War II have happened, which we'll talk more about later, you'll see hard assets do really well. Gold has performed particularly well during periods of conflict. So this is something to keep a close eye on, and we'll be watching the Chinese kind of relations closely. Black Lives Matters is obviously a huge issue, and what's happening now globally, not just in the United States, around this topic. There's a lot of factors that could be at play here. Obviously, long-standing concerns about racial equality. There's concerns about socioeconomic discrimination. And of course, the COVID situation, is disproportionately, it appears, affected ethnic minorities. And this is a huge issue that's at play right now. And no historical analogy is perfect, but I do want to highlight a couple similarities we see today with what's happening around the BLM protests and the rise of mobile money use in Kenya in 2008. So for those of you not familiar with the M-Pesa story, M-Pesa is one of the leading mobile money systems in the world, and took off in Kenya in 2008. And when you look back at the factors that led to the adoption of this new way of sending and receiving money in 2008, there's some interesting parallels. At the time, there was a political election season going on in Kenya, like we have today in the United States and other parts of the world. There was very significant ethnic and racial tensions driving a lot of unrest in Kenya. And there was a lot of distrust with the banks, which persists today. People certainly remember what happened in 2008, 2009. That distrust over the banks has not abated. We see that in polling data of millennials and others who still don't trust banks. And we also saw what we could describe as kind of a mini bank jog start to happen in places like the United States and the UK, a few months back with the COVID crisis and people withdrawing cash because they were worried about gaining access to their money. So, history, doesn't always repeat, but it often rhymes. It is very interesting to look at the factors and forces that gave rise to the rapid adoption of M-Pesa in Kenya in 2008, and see some similarities with what we're seeing today. And we'll talk about some other things that are interesting with the current context here in just a second. But I also want to reference some prior research I did on what gives power to adopting alternative currencies, because M-Pesa wasn't a new currency, right? It was just a new payment system. And that's one part of what cryptocurrencies offer, is a new payments network, but the other part is actually a whole new currency unit. And when you look historically at hundreds of years of alternative currency adoption, as I did in a research paper I published a few years ago, you find these 5 forces that really play a role in triggering wider use of a new currency. Economic instability, recession, unemployment, crisis, all things that are happening right now. Politics are a big factor. This could be everything from anti-globalization, concerned about keeping transactions and economic activity locally centered, to concerns about too big to fail, or maybe maybe Black Lives Matter is a political force that comes into widening cryptocurrency use. Advances in technology, entrepreneurs driving a lot of the action, and then financial inefficiencies, high fees, slow speeds. All of these forces are here today. And so I think this is kind of quite an interesting time to be thinking about what could trigger wider cryptocurrency use in the current context. And signal and noise, we're always looking for the signal amongst the noise. Well, we have the Signal app showing a massive spike in downloads at the end of May. For those of you not familiar with the Signal app, it's a messaging app, kind of like WhatsApp, that offers end-to-end encryption and is also open source, and has received a lot of funding, interestingly, from the former founder of WhatsApp. There was a huge increase in the use of this app at the end of May as the Black Lives Matter protests started to gather steam. This is an interesting data point for crypto because it suggests that the population is becoming more educated and aware of the importance of privacy and the value of encryption technology and the value of open source software. And all three of those things obviously are hugely important and a big part of what cryptocurrency is offering. And so this is the type of data point I think people in the cryptocurrency space need to keep a close eye on when they're thinking about, what signs are there that people are becoming more educated and aware of what cryptocurrency's value proposition is, the fact it offers censorship resistance. And if that became a concern, as protests continue, then that might be really interesting, an interesting factor in driving adoption. There's a lot of noise out there as we try to assess the current situation. I just want to briefly touch on the unemployment data that came out last Friday. These statistics that are being reported, I think, need to be taken with a grain of salt. There's there's these three factors that explain why macroeconomists have a really hard time doing their job. Three things that make macroeconomics very, very difficult as a discipline. One is the economy is constantly evolving, difficult to compare one period to the other. Number two, we don't have a very good understanding of cause and effect. And then number three, poor data, unreliable data, or data that's slow to be delivered or that is constantly being revised. And I think the unemployment data is definitely a candidate for problematic data, just based on classification issues and things that we don't want to get into in too much depth here on the call. But just want to caution everyone to be mindful of some of this data that's being reported and what it really means in terms of actual on-the-ground economic activity. And then again, this just a few days ago, coming back to COVID, there was a comment made in a World Health Organization press conference about how asymptomatic transmission of the coronavirus might be very rare, which would be a complete game changer. One of the factors that has made this disease so pernicious is that we thought that there was a lot of asymptomatic transmission, people not showing any kind of symptoms and being able to pass the virus on. Turns out the World Health Organization has kind of backed away from this. But the reason I mention this point is the fact that something like this might have some evidence associated with it just tells us still how little we know about the virus and how early we are still in kind of understanding its full impact and how this is all going to play out. And something like this, if it does prove true, could be an absolute game changer, although it appears too early to tell. And so what does this mean for all of us, who are trying to make sense of all this? And, I was thinking about Peter Lynch, who's one of the legendary investors. He ran the Fidelity Magellan Fund decades ago, wrote some books, went up on Wall Street. I was thinking about some advice that Peter Lynch gave to retail investors about how to get one up on Wall Street, how to beat the pros. And he encouraged the little investors, so to speak, to kind of look for local data or insights that they were exposed to in their everyday life. And I had one of these myself this week, and I just give it as an example, as something that kind of made me think, what does this mean? What does this little data point that I gathered locally mean? I was talking with a small business owner in my neighborhood who was telling me about the UK government loans that have gone out to small businesses, that don't have any collateral requirements. And he was telling me that a lot of his friends or people he knows, I don't know if these are his close friends, but people he knows are not planning to pay back this loan because it's not attached to their house. It's not attached to any of their other assets. And, in essence, there's going to be, right now, it appears very little consequence for not paying this back. So how significant is that data point? I don't know. Maybe it's just, a few folks looking to take that approach. But it just reminded me that you can actually gather a lot of data, interesting data points that then you could then use to maybe do some further research just by kind of, talking with folks around you, keeping your eyes open, following the advice of Peter Lynch, and seeing whether that little kernel that you've picked up on might have broader implications. Like maybe if, a lot of people are not paying back this loans, this has serious, budget implications for the UK government, which in turn could affect things like inflation and so on. So to wrap up, how will we pay for it is a question I think a lot of people are starting to ask about the current crisis. We've put this slide up in the past to highlight how even before the COVID crisis, the level of public debt, in advanced countries like the UK, the US, was already at World War levels, and we hadn't even fought a world war. We hadn't gone through something like COVID. Hard assets have done, as I mentioned, really well during prior periods with elevated debt levels. And when you have a debt problem, a public debt problem, there's only 7 distinct mechanisms for dealing with it. And some of these are less preferable than others from a political perspective. This is drawn from another paper I did on debt sustainability a number of years ago. And I think it's worth highlighting, where we think the debt problem could go based on this framework here. In the preferable side of the equation here, you've got economic growth. There's an old saying in business that sales cures all. You can think of economic growth as like that. As the economy is growing, tax revenues naturally grow with it. And debt markets get less concerned because your growth rate is hopefully above your interest rate you're paying. And you can kind of grow your way out of a debt problem. Financial aid is kind of another kind of mechanism for hopefully kind of delaying any pain so that economic growth can get in and cure. Those are the 2 preferred options usually for dealing with a debt problem. The less preferable options on the right side here include things like, raising taxes or cutting spending, selling assets. Governments actually own quite a bit, of land and other assets that they can sell. Those are very politically unpopular typically. Certainly default is not usually, or repudiation is not usually a preferred option. That affects access to credit markets, or some kind of inflation surprise, hyperinflation. That doesn't tend to be very politically popular. And so where that leaves you is kind of this kind of sneaky form of default called financial repression, which I would argue we've been in for a period of time, and it's increasing now with 0 and negative interest rates. And this is a way where basically there's coordinated action from the part of policymakers to keep interest rates low, and to kind of let inflation kind of help erode the real value of public debt steadily over time. That's what happened after World War II. And I think there's a very strong possibility that, to avoid these other ways of dealing with the debt problem, we kind of like approach financial repression, or what some people call today yield curve control. And with that, we now say, well, what should we do about it? What are our options? How can we respond to this? And, it's a great time to talk about, I think, the blockchain.com interest account. And I want to actually kind of hand this back over to Nick, if you don't mind, to come in and talk about what we're doing for our users as we face this low and negative interest rate environment, and perhaps years, maybe decades even, of financial repression in the wake of this debt problem.
Yeah, thank you so much, Garrick, and hopefully you get a chance to take a breather here. Appreciate all the perspectives and views. I think that the 5 different components of what cause people to change how they think about their money, or is really one of the most interesting insights I think I'll take away from today. What we have right now with cryptocurrency and things like Bitcoin is really just an alternative way of thinking about money. Most people on this call will spend their whole lives in pursuit of money so that they can accumulate it and they can earn it and develop wealth, so they can buy things they want and afford things they need, invest in their families, and take care of their loved ones. Money's been around for a long time. It's essentially a social construct. It's older than written word. And I think it's most broadly best to maybe think about it as like a collection of systems for transferring wealth. And fundamentally right now, if you hold your money in a bank account, which is what we've been told to do, to be careful our whole lives, you actually will be losing value on a day-to-day basis. And that is because of this systemic policy and coordinated response. And I'm particularly concerned about that. But I speak to dozens of entrepreneurs, and I've been speaking to contemporaries and colleagues around, well, what should they be doing? How do you go out and safely protect your wealth? And one of the ways to do that now is with a feature we've developed here at Blockchain. And so anyone in the world can use this. In fact, we just launched this product, and in just over a week, we've had 100 different countries and users from those countries test this product out. And so basically you can deposit your Bitcoin in an interest-bearing account and earn 4.5% on that. There's been a question from a lot of people, including some in the chat here, well, how do we do that? So there actually been a couple different companies that have been offering interest-bearing accounts in crypto. And the way we offer interest is by generating yield on the assets that are given to us. And until this launch, we've only offered that capability and product to institutional customers here at blockchain.com. And we published an article about this earlier this year. We've quietly been running a very significant lending operation here at Blockchain for over a year now, with hundreds of millions of dollars in loans to our customers on the institutional side. And we've never had a missed margin payment or default on any of those, including on the Black Thursday back in March, which saw historic levels of global market volatility. And so we're really excited about offering this product now. If you deposit 1 Bitcoin, you could be earning over $400 in interest a month. And a lot of original and Bitcoin users, and even newer ones, are sort of seduced by the idea of sort of resisting, I would say, or being resisting maybe the changes to the worldwide financial system by holding their crypto and being a hodler. This is sort of a meme in the cryptocurrency space. Well, now you can hodl and earn money on the side as well. And so welcome you to test this product out and give some feedback on it. If you want to see some other assets, let us know. Those are some things we're definitely currently evaluating. And we see this as a really timely response to the macro conditions. I mean, just yesterday, as you said, Chairman Powell said that the zero interest rates will be a standard policy for 2 more years. We're really in completely unprecedented times when it comes to what is going on in the stock market. I mean, we're seeing record levels of companies filing for bankruptcy. We have historic levels of unemployment. You've got companies that are underwater with stocks that are increasing by hundreds of percentage points over the course of a month. These things appear to be very unhinged from the economic reality that many people are experiencing. And so they're quite concerning to me for a variety of reasons. But I think it brings sharply into focus just how important cryptocurrencies are in this context, and especially things like Bitcoin. You have a money system that's based on an accumulation of that trust, which was a concept that we shared a little bit more on today. I think the other things, in the context of COVID, being able to use digital money makes more sense than ever. Just from a pure safety and hygiene perspective, that seems pretty obvious to me. But I think, if we look into the horizon over the next 5 to 10 years, setting aside all of the health crisis and the social unrest and the other things going on, it appears pretty obvious that the internet will be the world's growth engine. And the internet is going to need a native financial infrastructure for it to be able to exchange valuable information instantly across borders. And cryptocurrencies like Bitcoin and Ethereum and many of the other projects are working toward developing a low-cost, highly secure system to do that. And it's been operating now for over a decade, which I think continues to prove its use case for being able to transmit valuable information over the internet as easily as sending a message over text. So anyway, we would love to have you guys check out the blockchain.com interest account. Give us your feedback on that. We've had some questions come in, and so I'm going to ask Garrick one or two of these and then be conscious of the time because we're running quite a long one today. One of the questions that came was, how do cryptocurrencies gain value? And I think just briefly, maybe Garrick, for the benefit of the audience, can you maybe compare Bitcoin to maybe Ethereum or a stable coin, and just talk about some of the supply and demand dynamics for those, and specifically the currency supply, as we may have some users that aren't familiar with that today.
Yes. Okay. So yeah, when I explain this is actually a very, it seems like a simple question, but it's a hugely important one, and it's something that's essential to cover. What underpins the value of cryptocurrencies, or anything for that matter, US dollar and so on. Bitcoin has value and Ethereum has value, or any of the crypto assets have value, because they are both useful and they are scarce. All right, utility and scarcity are necessary but insufficient features to generate value. Now, why do I say they're necessary but insufficient? Well, if you go back to 2009, when Bitcoin was first invented and launched by Satoshi Nakamoto, that first year, it was arguably both scarce and useful, but it wasn't really worth anything. We generally mark the day that Bitcoin became worth something as Bitcoin Pizza Day, which was in May the following year in 2010, when Laszlo spent 10,000 Bitcoins for 2 pizzas. At that point, Bitcoin had value because people saw you could buy things with it, and then an exchange market developed, and so on and so forth. So demand is the other kind of crucial ingredient to support why something has value at all. In other words, you can have scarcity, you can have usefulness, but if there isn't demand for something, the value can diminish or go away completely. And if you look at national currencies, part of the argument behind why they will always have value is the government can force you to pay your taxes in them, right? That requirement, that legal requirement, you pay taxes in the local national currency, underpins their value. But if confidence is lost in the currency, eventually that doesn't even work. And we've seen examples of that, Zimbabwe very famously, where it doesn't matter what government is saying they want you to do. If confidence evaporates, the law is insufficient to kind of support value and further use of an instrument. So always keep in mind, demand is the foundational layer for why anything has value. But then if you go a level above, why does it have demand? Scarcity and utility. It's useful and it's scarce. Those are the key features. And certainly something that is maybe more scarce, a fixed cap supply, cryptocurrency like Bitcoin, versus something that has a steadily growing supply. That's one of the arguments you hear oftentimes for why maybe Bitcoin has more potential as a store of value versus something that has, an unlimited supply. But the utility piece is crucial, right? So, something may be less useful if it's too limited in availability, right? So getting the balance right is this kind of great experiment we have right now with cryptocurrency, and we're seeing it play out in real time. What's the right balance between scarcity and utility?
Yep. I think innovation in the design of money is probably one of the most interesting things that's going on in the cryptocurrency industry. And so we're seeing some really significant work being done on the R&D side there, and also seeing the application of a new social construct for money being applied to a world where we have more people transacting with each other digitally anyway. So one of the questions here is one I'll take really quickly, which is, are there any fees when sending Bitcoin from my blockchain wallet to the blockchain.com exchange? The answer is yes, you pay network fees to the Bitcoin network when you send transactions from your non-custodial wallet over to the exchange. Now, there are some traders that leave their funds over on the exchange. You always want to make sure you have two-factor authentication set up when you do that. We always advise users to store and hold custody over their private keys and over their funds. And so when you are moving your digital currency, and especially Bitcoin, from a wallet to a custodial venue, those transactions will typically be happening on chain. And when you do that, you have to pay the network fees. And that's why some of the data we were showing today that Tony presented can actually be pretty insightful around when to do those things to make sure your transactions are getting confirmed quickly. Essentially, there's so many people using the Bitcoin network now, you can kind of think of it like there's a rush hour. So Monday and Tuesdays, there are fewer people, and then at the end of the week, it kind of piles up. And so just like a highway, when there's too many cars on it, things slow down. Same thing happens on the capacity for the Bitcoin network. It's also one of the main criticisms is that we need to keep innovating to make sure we're adding more and more transactional capacity. And that's an industry-wide challenge. There's a question here. Let's see. Okay. There's one here. In what ways can blockchain technology be used to improve the equity capital markets? And I might let Garrett opine about that for just a minute.
Yeah, boy, that's a fun one. Yeah, where to even start there? Okay, so I'm going to just pick on John Corzine, former CEO of Goldman Sachs, senator, governor, very successful guy. Got into a lot of trouble running a firm called MF Global a number of years ago. And long story short, some of the customer funds that were at MF Global were used unbeknownst to the customers to speculate on European sovereign debt. Those trades didn't go well. And you know, one of the things that potentially blockchain technology broadly defined could have offered in this case is, you know, more customer transparency into how funds are being used and moved. You know, when something happens on chain, it's visible for everyone to see. That's an incredibly, I think, powerful feature of cryptocurrency networks and blockchain technology. Now, you know, in the case of a regulated securities market, it gets more complicated. There's, you know, competitors be able to see what your firm's customers are doing. You know, maybe this needs to be tweaked slightly in the case of capital markets. But there's also interesting possibilities around giving, for example, say a regulator a node on a network to see whether, you know, MF Global is doing something with customer funds or assets that they shouldn't be. Let's go back to 2008 to Lehman Brothers. Was just watching another documentary on the 2008 crisis. They're still being made, kind of reflecting on how lots of, you know, so-called little fishes, you know, the Madoffs and other types who are doing Ponzi schemes got caught, imprisoned, fined, but none of the Wall Street CEOs, none of the big kind of fish, if you will, were prosecuted. There was no effort even to prosecute them. You know, I mean, Lehman was engaging in some repo transactions that, you know, I mean, a lot of people, attorneys, regulators, et cetera, think were highly illegal and certainly very misleading. And again, it's kind of an MF Global type situation where if you had more transparency and real-time visibility, then that type of thing may not be as easy to do. And today, you know, as we increase, you know, our ability to audit on-chain proof of funds, these kinds of things, I think we're starting to take steps in the direction of really leveraging the transparency of blockchain technology to strengthen kind of confidence in the crypto asset industry and ecosystem first and foremost, but also think about ways we might be able to deploy these transparency measures and kind of provable funds and so on to kind of the broader capital markets. I think it's one of the most exciting possibilities for this technology.
Yep, and I think, you know, as more people become informed around what is going on with the market structures today, the demand to develop more transparency on these systems will increase. And so I thank you for your time, Garrick, today, and also Tony and everyone who's joined us from around the world. Thank you guys very much. We'll be posting this up on YouTube, on the Facebook account, and this will be accompanied by a blog that covers all these topics as well. Please follow us on Twitter, and you can always catch up on the latest things that we're reporting on. And all of Garrick's research, along with his teams, is available on blockchain.com/research. So thanks to everyone for joining us today. Please stay safe, and we'll see you next month. Cheers.